I'm Howard Prager, a 78 graduate and member of A Day with Northwestern Executive Board. I'm pleased to see you here all this morning. Thanks for joining us for the 47th Annual Seminar Day featuring outstanding alumni, faculty, and staff. Quick show of hands, how many of you have been here before? Whoa. Whoa, well, heck, you should be up here introducing everyone else then. That's great. And how many of you have heard Brian before? Brian, take a look at this. You know, marketers pay big money to get this repeat business that you keep getting here. So, thanks for being here. Let me ask you one more thing. How many people have one of these? Would you take it out right now? And I'm not going to tell you to turn it off. I'm just going to tell you to silence it. So hit the button that silences it, but keep it on because we have a great day. And if you're on social media, on Twitter, the hashtag is adaywithnu. So feel free to tweet any great ideas or thoughts that you hear or have from today. Hashtag adaywithnu. Thank you. And now I'd like to introduce our featured speaker this morning. Brian Wesbury is a graduate of the Kellogg School of Management and chief economist at the financial services firm Trust Advisors. And Brian has just told me he's got 100,000 miles on United already this year, and he said, and he flies United the least. So you can imagine, he said, like last year, maybe he'd do like Atlanta one day and Birmingham the next. He says, we're doing 2 a day now, and we're flying from one place to another. He is absolutely in demand, as you all know, a skilled and gifted speaker and advisor. He was a member of the Academic Advisory Council of the Federal Reserve Bank of Chicago from 1999 to 2007, and in 2012 he was named a fellow of the George W. Bush Presidential Center in Dallas. His articles have appeared in many national publications, and he appears regularly on Fox, Bloomberg, CNBC, BNN Canada TV. In 95 and 96, he served as chief economist for the Joint Economic Committee of the U.S. Congress. In 2001, the Wall Street Journal named Brian as the nation's top U.S. economic forecaster. His success started early in life. Brian and I share both being Eagle Scouts, and we both are proud of that. He's also a mainstay and one of the most popular speakers, as evidenced by our attendance here today and the repeat visitors. So please join me in welcoming Brian. He'll give a presentation called The Model of Wealth Creation. Thank you, Brian.
I feel like I'm supposed to do the scout salute. All right. Well, good morning, everybody. Let me get my little pen started up here today. And I just want to tell you that if I look around this room, there's 861 different things that you're all thinking about, or the most important thing that's happening, or things. And I can't talk about all those. I'm not even going to try. And so I love the Q&A part, so do you. So we're going to get to that as fast as we can. So the way I'm going to get there actually today is I'm going to start by telling you a little personal story. Last November, First Trust, my company, we have, I think, 98 ETFs, exchange-traded funds, in the market. We have an office in London, and we just signed a deal with the third largest bank in Santiago, Chile, to distribute our ETFs in South America. And they asked me to go down, BCI is the name of the bank. They wanted 3 speeches, one to their board, one to their best clients, and one to hopeful clients. And I'm like, sure, that's my job, I'll go do it. And then I looked at the flights. I mean, you've been there, or a lot of you have. It's a 14-hour flight from Chicago. And I'm like, what? I mean, like, I could be in Shanghai, I could be in Melbourne. Like, I had no idea it was that far down there until I started looking into flights. And then I'm like, okay, I'm going to go do this, but if I'm going to do that, I'm going to check a box off my bucket list, and I'm going fly fishing in Patagonia, all right? And which, by the way, is another 2.5-hour flight south of Santiago, And this is not on a Cessna, it's on an A320, all right? So we are way the heck down there. There is nobody there. A lot of you have floated, maybe you're fly fisher men or women too, where you drift boat. But usually you put the boat or the canoe or the inner tube or whatever in the water, you float down, somebody has ferried your car, or they have a bus and they bring you back, right? It all works out. But down there is nobody to ferry. Unless sheep can drive, there's nobody ferrying anybody anywhere, all right? And so you use a little jet boat. I've never seen one of these things before. It's got a little 30 horsepower outboard motor with no prop, just a little jet engine, like what you would see on a Sea-Doo kind of thing. Anyway, the draw on this, you never go past your car downriver, because you have to be a Navy SEAL to get, it's one of those guys that gets dropped off with a toothpick and a match, to get back. So you always go upriver, never go past your vehicle. So and it's all mountain lakes and rivers, and if you've been, it's all glacier melt, basically, is where the water's coming from. So it's 39-degree water everywhere, all right? And we go up a river, across the lake, up a river, across the lake, up a river, into this third lake, and that's where we start fishing that day. The middle lake happened to be the biggest one. And so we fish the lake, it's awesome. We fish the river, it's awesome. We get to that middle lake, it's like 7 kilometers long, about 5 kilometers wide, and we have to go right down the middle of it, and the wind is right in our nose. 40, 45-mile-an-hour wind. And the waves are 2.5 feet, white caps. Every time we hit one of these things, the engine's coming out of the water. We had this thing turned all the way up, and we're not going anywhere. And so the guy, Monty, he's like, gets the guy in the middle of the boat to come back with him, put more weight to keep the engine in the water. I'm in the very front of the boat. I don't have my life jacket on. I'm looking at this water. I'm looking at my life jacket. And finally I'm like, well, do you want me to go to the middle of the boat, for more weight? He's like, no, like you're ballast. Like, in fact, can you lean out further? All right? And I'm like, I put my life jacket on, all right? And this is it. You last 10 minutes in this water. I'm scared to death, all right? I'm gonna die right here, all right? There's nobody gonna come help me. And Monty, who's the guy, he's from Wyoming. He was born and raised in Wyoming, but he's lived in Chile for 23 years. I do not know what the arrest warrant for him is, but I'm sure there is one out here. But nonetheless, he's been down there for 23 years, and he screams at me, into the wind, Brian! And I'm like, what? And he's like, what's the difference between an adventure and an ordeal? And I'm like, this is a quiz in the middle. I'm like, survival? Like, is that what it is? And then he goes, no. The difference between an adventure and an ordeal is attitude. All right? And I love that line. I've never heard it. I'm 57 years old. I've never heard it in my entire life. And I believe that in a way that should be an investor's mantra, an economist's mantra, if you will, especially over the last 7 years. Now, just for a quick update, you might have heard that the founder of North Face died in Patagonia, and it was in that lake. He was kayaking. Now, we were in a rubber raft, but he was kayaking, and it was the same kind of day. And they capsized. He was in the water for about 12 minutes. It was a scary place, but nonetheless, it was beautiful, absolutely beautiful. I'm so glad I went. That box is checked, all right? And so anyway, having said that, what I really want to get to here today is, what is the difference between adventure and ordeal? Because we seem, if you kind of think back over this last 7 years, we've talked about it over and over and over and over again. Greece and Italy and Spain and China and QE and tapering and rate hikes and negative interest rates and TARP and Ebola. I mean, the list of, all these black swans that are out there. I mean, I call them a flock of black swans. They're just flying everywhere, and everyone is terrified of them. And as a result, we have a normal correction like we did earlier this year. The market was down 10, 12%. It's called a correction. I don't know exactly what that means, but we had one in 2010, we had one in 2011, and then USA Today publishes right when your statements are coming out for the first quarter about, basically the end of the world and this extreme collapse in the market. And it wasn't. It was just a normal collapse, but everybody gets scared every time the market goes down. All right, this is it, it's over, it can't last any longer. And so the question is, where does all of this come from? Why do we keep thinking of this as an ordeal rather than a continuation of an adventure? I mean, I kind of think if you really want to talk about an adventure, you think about the 240-year history of the United States of America and what we've accomplished. And yes, there have been awful things that have happened along the way, whether it be civil rights and the Civil War, or World War I, and World War II, or the Great Depression, or any of those things. All of them have been awful, but if you look at this last 240 years, it's been one grand adventure. We have created more wealth than any country on the face of the earth. We have lifted more people out of poverty than any country on the face of the earth. We have invented more technologies that help people in their health care, in their communications, in their safety, than any country on the face of the earth. And that's an adventure. And if you don't have a good attitude about that, I can't help you. All right? All right? So, thank you. All right. So what I'm going to tell you is that I don't think the last 7 years is much different than that. It really isn't. However, sometimes it's hard to dig down. So I'm going to talk about three things today. I'm going to go back and talk about 2008. All right? And some of you are like, not again. All right? I know it sounds like I'm making fun of her, but people want to go, well, at this point, what difference does it make? That's Hillary Clinton about Benghazi, right? It's like, are you kidding? We're still talking about this? But I'm going to talk about it, all right? And I want to go back and we have new information I want to share a little bit with you. Number two, I want to talk about why the U.S. is growing so slowly. In economics right now, one of the biggest debates is why we're growing so slowly. In fact, Robert Gordon, professor at NU, has written a book called The Great Stagnation. I do not agree with his conclusions, but it's all about why we're growing so slowly. So I'll talk about that. And then the third thing I want to do is just get to my forecast for the next year or two, so to speak. All right, and just kind of think about where we're going to go, interest rate, inflation, stock market wise. So let's go back to 2008. How many of you seen that movie, The Big Short? All right? Okay, great. So I saw it in Chattanooga, Tennessee at 10:15 at night. There were like 5 of us in the theater. And remember that first screen that pops up? It says, "This is a true story." and I saw that screen and I laughed out loud. By the way, I was texting the whole movie too. But anyway, there was only 5 people, so they didn't care. But now I want to be careful here because it is a true story. There is a guy that wore cargo shorts to work every day and didn't wear shoes and played drumsticks on everything he could find and listened to AC/DC in his earbuds, and he made $2.9 billion. True. Absolutely true. There were 2 kids that basically traded in their garage and they made $80 million. I mean, there were all these characters and they made great money. All right? But just like all of Hollywood now, they love the F word, and they always use the F word before banks, investment banks, and Wall Street. And that's where the untrue part of the story comes in. Because what they will tell you is that we were given this opportunity to short this market because Wall Street is greedy and evil and they put all these people into mortgages that they shouldn't have been put into. And that's what I think is the lie. In fact, I call the movie The Big Lie. All right, and let me put it this way. I'll make this analogy. Abraham Lincoln gave the Gettysburg Address. We know what he looked like. We know what words he said. We kind of know what he sounded like. And if I put an actor right here and had him look like Abraham Lincoln and give the Gettysburg Address, is that a true story or not? It's true that he said those words. It's absolutely not true that he did it here. All right? And that's the movie, right? It's true, all the little parts, but the bigger picture is wrong. So let's go back to 1938. Fannie Mae was created. In the 60s, 68, 69, Freddie Mac was created. Only government needs 2 agencies to do exactly the same thing. All right? But what they do, and the whole reason we started Fannie Mae, was if you're a bank, you make a mortgage, you got to get paid back before you make another mortgage. mortgage, right? Or you at least have to get a bunch of mortgages to pay you little pieces back before you make another mortgage. So what we did is we invented Fannie Mae, and Fannie Mae would go in and buy the mortgage from the bank. All right, and then they would buy a bunch, and then they would make an investment pool, and this started back in the 30s. All right, and Freddie Mac did the same thing, and what this did is it helped the mortgage market become more liquid. Now, to be honest, and you all know me, I'm a libertarian. All right, so I mean, I'm always looking for the private sector solution to things, but I wouldn't call Fannie and Freddie evil, awful things. Just, you know, I mean, I wouldn't do them myself exactly, but they're not going to cause me to forecast a recession or some end of the world. All right, so don't get me wrong. And in fact, for decades, the default rate on the mortgages they bought were less than 1%. This worked out really, really well. Why? Because they only bought mortgages where people put 20% down. They only bought mortgages where people's credit scores were over 700. Debt to income ratios were low. They bought good paper, all right? And then in 1992, we decided as a nation, both sides, bipartisan, HUD and Congress, came in and said, guess what? Fannie and Freddie, this has worked so well, you have to now spend 30% of your money buying loans for low to middle class neighborhoods and families, all right? And I gotta tell you, I was in the bond business for a long time. One of my favorite customers. My grandmother came through Ellis Island. She's Polish. There was a Polish SNL down on the west side of the city, and I love it. They're all Poles in there. They were. It was a Polish neighborhood. Every lawn was mowed in the whole neighborhood. Every fence was perfect. Every shutter was painted, and every mortgage was paid on time. It was a complete blue-collar neighborhood. There is nothing wrong with these loans. In fact, they had a lower default rate than Fannie and Freddie did. Okay, so at 30%, you're not. You didn't destroy the portfolio, all right? But then we raised it to 40%, and then to 50%. And by 2004, it was up to 54% of all the money that Fannie and Freddie spent had to be used to buy low to moderate income loans. And by the way, they always met their goals. And how do you meet your goal? You lower your standards. So they were taking loans with no down payments. Credit scores, turns out the key credit score is 660. You start taking loans below 660, you are looking at defaults, serious chance of defaults. And in 2007, and by the way, if you're interested in this at all, if you don't think it's something we should just get over, all right, go get Peter Wallison's book, was published last year, and it's called Hidden in Plain Sight. We knew this back in 2009. We just didn't have the data to prove it. He published the data. And here's the key point. In 2007, when the crisis really hit the wall, so to speak, we started to see it. Fannie Mae and Freddie Mac owned 76% of all the subprime debt in the United States. That means Wall Street only owned 24%. So let me ask you, who caused the subprime crisis? And this goes all the way back to 92 when this started to build, okay? I don't know, I live out in Glen Ellen, Roosevelt Roads there. There were 5 mortgage brokers, like within a mile and a half. Then they all went under, and you know what came up in their place? Cash for gold, right? All right? And so all those guys were there, and then they went under, and now you know what's there? Smokeless tobacco, all right? And by the way, it's the same management, all right? All of them. Like, these weren't mortgage brokers. They were just on the hot trail. And Fannie and Freddie would buy anything, all right? And by the way, I'm not saying investment banks didn't get involved, but it wasn't investment banks that drove the market, all right? That's the first part of the lie, all right? That we totally leave out government, and in The Big Short, all they ever say is banks, investment banks, and Wall Street with the F word before all of them, and they are evil. Well, government really helped push it. The second part of the lie is that, so what they say is Wall Street caused the crisis and then government saved us. So this is the S&P 500, just the overall stock market, the 500 biggest stocks. And if you look at this, is all of 2008, and then the first half of 2009, up through the end of June, okay? So every one of those red dots was a Federal Reserve Board meeting during 2008. All right? They normally have 6 or 7 meetings a year or something like that. They had 17 that year, I think, if my numbers are right. Every one of those meetings, the Fed did something. They cut rates, they invented a new acronym, and started a new program. They used every letter of the alphabet. They pumped more money in, they did QE, all that stuff. They cut rates from 5.25 to 0. All those red dots. Did it help? Actually, it looks like the more they met, the worse it got. Now, what they'll tell you is the worse it got, the more we met. All right? So you have to decide, was it the chicken or the egg? But let me give you 2 points on this chart. All right? Right here was when we started when the Fed started quantitative easing, which, you know, is the Fed just went out and bought bonds. Now remember, when Fannie Mae buys a bond, a mortgage bond from a bank, they actually they issue bonds on the other side. They have to raise the money to buy the mortgages. The Fed, when they want to go buy a bond, they just print the money. They create it out of thin air. Completely different, all right? And so we started QE. They just started printing money. It's called helicopter money, so to speak, okay? TARP was passed right here, October 3rd, 2008. And what everybody remembers about TARP is that the day that it failed in Congress, the market went down, I forget, 500 points. The day that it passed in Congress, the market went up 700 points. And so they therefore say, see, TARP worked. But what they don't say to you, it looks like JARP, sorry. It's TARP, all right? What they don't say is this, and that is that after TARP was passed and between the bottom, the market actually fell 40%. So did TARP save us? Doesn't look like it to me. By the way, TARP was designed to save the banks. And did bank stocks fall more or less than the S&P? Because if it worked, they should have fallen less. But guess what? Bank stocks actually fell 80% in that 5-month period. I don't believe government saved us either. So the lie is that Wall Street killed us and government saved us, which, by the way, if you understand history about the Great Depression, it's the exact same thing that everybody says about the Great Depression. And Milton Friedman fought that war his entire life, wrote books about it, and in a way, we have the same war today. All right, political war and historical war. What saved the economy, and you can ask about this if you want, and there's a couple of you who have debated me over the years because we've talked about it, is when we changed mark-to-market accounting. And the whole point here, just to put this as simply as possible, is that if you have a pool of mortgages, 1,000 mortgages, 300 of them go bad, 700 are still paying, that bond, that pool is worth 70 cents on the dollar. But because of mark-to-market accounting, nobody would touch it. And the market dried up, and there was no market. So even though you got paid 70 cents per dollar, so to speak, in interest, the thing was only priced at 10 cents. Because the only bids out there were these low-ball, pick-off, fire sale bids. And if you're a bank, what mark-to-market accounting says is you have to mark that down to 10 cents, even though it's worth 70. All right? And so what we did is we destroyed capital with this accounting rule. It was an overly strict interpretation of what mark-to-market should be. And that's why we invented TARP, was to fill the hole in that accounting rule was created. And that's why the hole would have never been filled as long as we had that rule. And so once we changed it, and I've said this before, and this is just mind-boggling to me, but you know who was the head of the committee that changed it? Barney Frank. All right? Amazing. Because a lot of people blame him for Fannie Mae and Freddie Mac, but he actually changed that rule. And this is my whole point of coming through to the end of this. This, since then, has been a normal recovery. Now, that's just the first 6 months, okay? We've gone on to a 200% increase in the stock market, a 6.5-year recovery in the economy. We've got 73 months in a row, one of the longest stretches ever of private sector job gains. The economy's been growing. Now, it's been growing slowly, but it's been growing normally. And what I mean mean by normal is this, and that is what drives growth and has driven growth in the U.S. for 240 years is entrepreneurship. And if you think about the last 7 years, we have fracking and 3D printing and the genome. I mean, this university is right in the middle of it all right? I mean, it took a decade and over $1 billion to crack the genome. Now they got ads on the radio, and I can get it done for $400, all right? And it takes a week, all right? And in reality, it takes a couple hours. All right, we are on the cusp of some of the greatest inventions in genetic engineering and in pharmacology that the world's ever seen. And it's happening right now, and it's been happening over the last 8 years. We have gone from the world's literally one of the smallest producers of energy to the greatest producer of energy. Did you know last year we ran a trade surplus with OPEC? First time in my lifetime. And it's because of fracking. We have 3D printing, the cloud, smartphone, tablets, apps. All right? All of these things are driving wealth. They're driving productivity and efficiency, and they're driving profits. And that's why the stock market is up, and that's why the economy is growing. That's why I call this a normal recovery. Yes, I called it a plow horse. But a plow horse is still a horse. We keep calling this a new normal, but it's not. I mean, France has grown 2% a year for 40 years. It's an old normal for them. All right? So then the question becomes, why are we growing so slowly in America? And there's a lot of debate about this, tons of it. Like I said, Robert Gordon has this book, and he would claim that computers really don't raise productivity. And I would argue that he doesn't use Walgreens or CVS. He especially doesn't use their apps. All right? I don't know. I mean, they have 8,200 stores in the Walgreens network. They built a little app. They spent less on that app than they did on the inventory in one of their stores. You ever use their app? I mean, I'm on a blood pressure medication. I hit the button. They ask my doctor, my insurance company, is it okay to refill this thing? They say yes. They send me an email. I say, well, guess what? I'm not going to be in Glen Ellen. I'm going to be in Scottsdale. And I look on the map, and I'm going to be at that hotel, and this is the one that's closest to it. And boom, I just say, and move it. That app has made Walgreens worth way more than selling all the inventory in one of their stores. Small investments have huge returns. And so what we're seeing today is that this technology is lifting productivity, efficiency, and profits. The way you can tell is you look at corporate profits. But so then why are we growing so slowly? And this may seem like a weird place to start, but there's 3 lines on this chart, and I want to go through them real briefly, all right? So here's what we did. We went back to 1990, and I want you to focus on this orange line first. Okay, so who was president in 1990? That's H.W. Bush, right? So we had $1.2 trillion in spending. That was the entire federal budget, $1.2 trillion, all right? And what I asked my staff, I say, guys, look, I want to take that $1.2 trillion and I want to grow it over time by population plus inflation. So in other words, at the end of time, or the end of the chart, in this case 2015, how much would we have to spend to be spending the same amount per person that we did when George H.W. Bush was president? And it turns out the number is $2.8 trillion, okay? Now, the actual spending is the blue line. That's $3.7 trillion. In other words, today versus 1990, we are spending 30% more, roughly, per person, adjusted for population and inflation, than we did in 1990. That's how much our government has grown. Okay? Now you want to look at the impact of that on the budget deficit. Here's our tax receipts. Last year, you may not even know this, we had $3.2 trillion in tax receipts. Look at that. I mean, it is so far above historical peaks. We're way above where we were in 07, 08. This is record tax receipts. And if we would have kept spending down here, we would have a $400 billion surplus today. Instead, we have a $450 billion deficit. The reason we have this deficit is because we spent more, all right? We've raised taxes. We went back to the Clinton tax rates. All right, we put Obama surcharges on things. We have the highest corporate tax rates in the world. We're record corporate tax revenues, and we're now, by the way, the deficit will only get bigger from here. Because the population is aging, and Social Security, Medicare, and Medicaid spending are going through the roof. All right? And so the bottom line is, this is the smallest deficit we're going to see in the next 20 years by every account. Look at any OMB, CBO, any forecast coming out of the Washington establishment. By the way, they want to forecast the lowest deficits they can, but this is one of the lowest we're going to have. Now, some people look at this and they go, well, that's easy to understand. It's Bush's wars. I mean, we're warmongers. $2 trillion on the wars. Actually, the right figure is 1.7 trillion, but that's close enough. I'm not going to argue about that. But so here's what I did. I did the exact same thing that I just did on overall spending with defense spending. So here you go, 1990, George H.W. Bush is president. We're spending $300 billion a year on defense. And the orange line increases it by population. I mean, tanks cost more, ships cost more, everything. And today it would be roughly $625 billion if we wanted to spend the same amount on defense per person that we did in 1990. But what happened when George Bush was president? All right, we had the Berlin Wall came down. The Iron Curtain fell. We won the Cold War, right? And so both Bill Clinton and Papa Bush benefited from what we called the peace dividend, right? We won the Cold War. So now we don't have to have this big two-front defense and all this stuff. And so we actually held defense spending flat. And then what happened? Now, some people would argue it's because of that. But then we had 9/11. All right, I'm not saying that's why, but some people do. And then George Bush started 2 wars, and then Barack Obama ended 2 wars. Isn't that, I mean, I love one of the reasons I love economics is that we have numbers. We can actually show history and data, and there you go. The peace dividend, the 2 wars, 9/11, and then the end of the 2 wars. All right, change in philosophy, however you want to think of it. But if you add up all the dots on the blue line, they're actually less than the orange line. And today we are spending less on defense per person than we did back in 1990. So let me ask you, is the budget deficit today caused by defense spending? It's pretty clear it's not. All right? In fact, we're spending less on defense, not more. All right? So let's look at non-defense or ex-defense spending. All right? And here you can see Bill Clinton actually held the line pretty darn well. He barely increased spending above population growth. Then George Bush got in, and the compassionate conservative raised spending pretty dramatically. And then we had TARP and Obama's stimulus. And by the way, both of those were supposed to be temporary, right, to save the economy. And then once we got back on our feet, we were going to cut those down and bring the line back to normal, if that's what you call normal, okay? I think this is normal, but nonetheless. But you know what? There's no such thing. There's no more permanent thing than a Washington temporary spending program, all right? And in fact, we kept spending. Did you know last year we gave 8 TARP loans out? 6.5 years into the recovery, we're still giving TARP loans out. Like, it never died. It never went away. All right? So it was supposed to be this temporary thing. And then, by the way, just for you Republicans in here, this is 2014, this is 2015. Who was in charge of Congress? The GOP. We have an all-time record ex-defense spending. That's where the budget deficit is coming from. Now, I'm going to do theoretically first, and then I want to tell you a story that I've told some of you before, but theoretically it's really simple. Every dollar of GDP is divided into 1 of 2 pots. It's either public spending or it's private spending. And if it's public spending, government spending, it has to be either borrowed or taxed from the private sector. There's no other place to get it. So the more you move to the public sector, the less there is in the private sector. And when you have less in the private sector, you create fewer jobs, you create less growth, you have less investment. All right? And this is the story, the parable that I've told many of you And I'm going to do it to remind some of you, bore some of you, because you've heard it before, or to tell some of you brand new. But here's my favorite parable about economics. And I believe if you think about this parable, you will understand more about economics than 99% of economic professors out there. All right? I really, truly believe that. So let's imagine there's 10 of us. We live on an island. Every day we wake up and we catch 2 fish. And in 2 fish is just enough protein and calories to keep you alive to the next day. All right? You get sick, you're in trouble. And by the way, if your neighbor gives you something when you're sick to be nice, they're in trouble. All right? This is subsistence living. And we have all, we live in such a comfy world. And, we tell our kids that all the time. You better eat your food. The kids in Africa don't have enough. Well, that exists today. But go back in history. How many of you ever read Pillars of the Earth? I highly recommend that book. I love historical fiction. It's easy to read. I didn't want the book to end. I loved these characters. But there's this scene in this book where there's a father and 2 sons and a mother-wife pregnant walking through the woods. They're peasants. They've been kicked off the farm by the Duke or the Earl. I can't remember. They are homeless. They're walking through the woods trying to find somewhere else to go, and the mother gives birth on the side of the road, and it's winter. And she dies in childbirth. And it's a father and 2 sons. And they have no sheep, they have no goats, they have no cows, they got no milk, they got no food. And you know what they do? They leave the mother, who's dead, and the baby on the side of the road. That's our life on this island. There's nothing extra. Now, by the way, I know you're bummed about that. But the monks save the child. He invents the flying buttress. It's awesome. But you got to read the book. But what I'm getting to here is that that's our life on this island. I just want you to understand this is what life was like. All right? And then there's 10 of us. And 2 of us, we powwow over the days. We're like entrepreneurs. All right? We took entrepreneurship at Kellogg. Actually, Kellogg doesn't exist because there's nothing to pay tuition. All right, but nonetheless, there's no student loans, there's no nothing. All right. So anyway, we powwow. We're entrepreneurs, and we decide we're going to give 3 days, and we're going to eat 1 fish a day, and we spend the rest of the time building a boat and a net. And we build this I-boat and this I-net. And we take the I-boat 300 yards offshore, and we pray before we throw this I-net in the water, and sure enough, that I-net comes out with 20 fish. It's an unbelievable success. All right, we've invented this new technology. We now come ashore, we got 20 fish between just 2 of us. It used to take all 10 of us to catch 20 fish. All right, now for me, I don't know about you, this would be perfect, because I like fishing, I told you that, but not ocean fishing. All right, I like fly fishing. So I want a farm with a river running through it. I'm going to grow corn, and I'm going to trade for fish. You might go pick coconuts and trade for fish. How about if you clean the fish and cook the fish and trade for fish? Or how about you fix the net and the boat and trade for fish? And now, think about it. Then on this island, we have mechanics, we have chefs, we have fruit pickers, we have farmers, we have fishermen and women. There are so many job categories on this island, we got to invent the Department of Labor to keep track of them. That's the way you create wealth. New inventions which increase the productivity. Now, instead of 2 of us catching 4 fish a day, 2 of us catch 20 fish a day, and we free up resources to create new jobs, higher wages, and by the way, now we have more calories than we need. Right? You got corn, you got fruit, you got fish. We invite the Indians, we have Thanksgiving. I mean, it's awesome, all right? And so that's the way wealth is created. But now, let's imagine a different scenario. All right? That boat's coming in, it's laden with fish, they're flopping around. There's 8 people standing on the beach. They're amazed. Their jaws are dropping. All right? And one of those 8 people, this is going to get me in trouble up here, is Bernie Sanders. And Bernie is a born leader. And he's like, this is not fair. Those Wall Street I-voters, they're rich, and we're poor. They catch 10 fish a day, and we only catch 2. They're the 1% we're the 99%. You know what? This is not fair. We're going to tax anybody that uses an iBoat, those Wall Street iBoaters, 80% of their catch. So the boat comes in, the 8 people march over, they take 16 fish. Each person gets 2 fish, they leave 4, they're nice. They leave 2 for each of the people with the iBoat. And guess what? Nobody is better off. No one. We have this brand new invention, and no one is better off because we've now redistributed the wealth that the new invention created. And by the way, if you have a 40% tax, you get rid of half of the benefit of the iBoat. A 20% tax, you undermine a quarter of the productivity of the iBoat. So every time you redistribute something, you undermine the ability of new technology to raise living standards. Let me put this in a little more stark terms, okay? If that's not stark enough, all right? Here's three lines. It goes back to 1967. The top one is Social Security disability, all right? And if you average monthly payment, it's up 1,100%. This is a first-class postage stamp, the orange line. That's up. If I would have thought about Tennessee, I would have never brought orange lines up here. But nonetheless, 900%. All right. That's up 900%. And this number, average hourly earnings, you hear it all the time. Every month we get the employment report. We take all the jobs, divide them into all the earnings, and we get average hourly. That's up 500%. So guess what? These are people with jobs. And they have to pay, they're earning 500% more, and they have to pay 900% more for postage stamps and 1,100% more for people that are on disability. You want to know why the middle class is hurting? Because government is growing faster than wages. Now let me put a couple other lines on here. How many of you own an iPhone? All right, everybody. All right. So I don't know about you, I go to the store, there's 3 versions all the time, right? It's 16 gigabytes, 64 gigabytes, 128 gigabytes. I look at this 128 thing, and I'm like, who in their right mind would ever need that? My 11-year-old is like, me? You know? But I'm like, 16, come on, that's not enough for anything, you know? I'm a medium guy, medium shirts, medium phones, so I got a 64 thing. All right, did you know in 1991, guess how much 1 gigabyte of flash memory cost? $45,000. 64, the medium, times $45,000 is $2.88 million bucks. That is a $3 million phone in your pocket. And you got it for 99 bucks plus a 2-year plan. Okay? And so let's draw that on the chart, sort of. I don't know how to do it exactly right. But boom. How about televisions? Cameras? All right? Oil, natural gas. All right? If you think about, by the way, do you know that if a Rolls-Royce Silver Shadow, I have no idea how much one costs, 300 grand, it doesn't matter, because I saw these stats, they had the right stats. If a Rolls-Royce Silver Shadow were to fall in price the same rate as computer chip prices had, you could buy a Rolls-Royce Silver Shadow today for 1 penny. I mean, hand-stitched leather seats by, 212-year-old artisans. I mean, they polished the chrome on that car with Margaret Thatcher's hair. All right? And you get it for a penny. All right? I mean, you think about this. What's interesting, you start thinking about all these prices, televisions, cameras, phones, the app, the cloud, all these things, and then compare it to 500% increases in wages. This is actually making people's living standards go up. Right? The private sector is actually helping your living standards in every area that they operate. All right, so take a look at this. Want to add 2 more lines on here? How about healthcare and education costs? How about that? Plus Social Security disability. And this side of the equation is hurting people's living standards. So when you have costs that rise faster than incomes, your living standards go down. When you have costs that fall relative to incomes, your living standards go up. And I believe this chart explains our economy, and I'm going to close right here and move to my forecast to get to questions. And that is that we have 2 economies in America today. And by the way, in the world today. On one side, we have these unbelievable companies. I've mentioned, I don't know, Apple and Walgreens, and all of them. Boeing, the 787 Dreamliner is unreal. I just flew it to Australia. It was an unbelievable plane. But anyway, you think about all these companies, these are racehorse companies. They're thoroughbreds. They're throwing off record corporate profits. They're raising productivity. They're inventing new things. They're pumping out oil like never before. They're cracking the genome faster than ever for nothing. All right? These are racehorse companies. So they're thoroughbreds. And then we have this other economy. And I'm going to, for lack of a better word, I'm going to call it government. All right? The last person in the world I would want to be today is a 52-year-old Greek museum worker. I mean, think about it. I worked 18 years. I slaved away, 32 hours a week. And in 2 more years, I was going to get to retire at full pay on a Greek island, no less. And now it's not happening. And by the way, that was true about Detroit, and it's about to be true about Chicago. These are dead horse economies. Governments don't create wealth. They never have, and they never will. And in fact, when a racehorse is forced to drag a dead horse, it turns into a plow horse. That's where I get the plow horse economy from. It's these two sides of the equation, where the private sector is boosting living standards and the government is reducing it. And so when you put all of that together, it's the plow horse economy. So think about this. When you measure GDP, you're measuring the plow horse. So GDP is only growing 2%. But have you ever invested in shares of, if a financial advisor ever called you and said, let's buy some GDP today? How about some non-farm productivity growth? All right? Or have you ever shorted the labor force participation rate? I mean, we're thinking of starting an ETF just to do that, because there's so many people out there that talk about it. But you can't. No, you buy shares of Apple and Walgreens and Boeing and all that, and United and Delta. That's what you buy shares of. And so when you look at your stock portfolio and it's up 200%, the economy's only growing 2%, guess what? I get it. You go, oh my gosh, this has got to be a bubble. But in reality, you're comparing pomegranates and bananas. You're comparing racehorses to a plow horse, to a dead horse, however you want to think of it. And so remember that when you're investing. You're not investing in GDP. You're investing in the entrepreneurs that run that company and the inventions that they create. That's what you're investing in. And that's why investments have done so much better than the economy. And so to finish all of this up, if you look at last year through the fourth quarter, earnings were down. And that scares a lot of people. But if you take energy out, earnings were actually up. It's really all an energy story. And everybody, and by the way, all that energy investment, pipes and trucks and pumps and drilling rigs and all the steel and all that, and rail cars, and it all just stopped last year. And so yeah, we've had slower growth, and we're going to have slower growth in the first quarter. It's kind of a continuation of that. But underneath all of this, housing and autos and consumer spending, because driven by lower gas prices, it's all picking up. And so in reality, I don't believe we're going to have a recession this year at all. I think non-energy earnings, even energy by the end of the year, is going to have turned around with energy prices stabilizing. But non-energy earnings are going to grow about 8 to 10% this year, and I still believe the market will be 15% higher at the end of the year than it was at the beginning. All right, which if you think of the S&P 500 is trading like 2050 right now, I have it at 2375 by the end of the year. And if I would have said that 6 weeks ago, you would have really thought I was insane. But it's really only a 15% increase. The market's still cheap. I do believe the Fed's going to raise interest rates this year. Inflation is picking up. They said 4 times first, then they went back to 2, then everybody thinks they went to 0, now they're back to 1. I don't know. A couple of times probably would be my guess. So interest rates finish about 1%. And I would remind you that the board of Apple spends 0 time debating whether the Fed's going to raise rates 2 or 3 times. CNBC, they debate it 82% of the time. I would follow the lead of the board of Apple, not the talking heads, okay? And so I think oil's undervalued, I think gold's overvalued. But in the end, what's really happening is that we truly do have a great adventure going on today. And sometimes it's really hard to see because everybody thinks it's an ordeal, but that's because you have a bad attitude. So I'm telling you, you have a good attitude. Thank you very, very much. Wow, I talked too long. All right, yes, sir. Yes.
Okay, as usual, terrific.
Oh,
Lots
thank
of
you.
fun, lots of jokes, love it. Cover of Barron's, usual funds.
Yep.
Why Rates Must Rise by Bill Gross.
Mm-hmm.
Okay, we've been at 2%, and we've been at 0% real rates for 7, 8 years, whatever
Right.
it's been. Does that, to extend your metaphor, your analogy, represent the government economy? After all, it's the Federal Reserve that holds
Right.
those rates down. And
Yeah, you know what's interesting
is
is,
it possible that as rates rise, the private economy will actually start to grow,
yes.
and the economy will expand when rates rise?
Yes, okay, so this is a great question. I'm so glad you asked. I'm going to answer these really fast because I want to get to more. But there's really two scenarios right now. The Fed's raising rates, and Japan and Europe are going to these negative interest rates. I mean, a lot of us are old enough. Remember when you used to take $250 in the S&L and deposit it and you came out with a toaster? You know? Well, now you have to take a toaster in. All right. So negative interest rates, you know you can't get a safe in Japan right now. You can't get a safe. And you know, and by the way, Larry Summers says he wants to get rid of the $100 bill. And he actually says it's because of drug dealing. Well, drug dealing's been around for like 50 years, and I haven't heard Larry Summers say this. What he really is trying to do is that if we ever need to go to negative rates, it costs twice as much space to hold $50 bills and 5 times as much space to hold $20 bills. So getting rid of the $100 bill makes it harder to hold cash. And when people take cash out of the system and just call the money and banking professor at Kellogg, and you'll find that, you know, what happens is the money supply shrinks. It actually, negative rates are backfiring in Europe and Japan. Positive rates, to go to exactly what you're saying, is that as we raise rates here, it's actually more profitable for banks to lend. And in the last 3 months, it's amazing, commercial and industrial loans are up 15%, and M2, that's Milton Friedman's favorite measure of money, is up 8% after growing 6% for about the last 5 years. So in fact, we're seeing the money supply start to accelerate. So if that's what Bill Gross says, I don't agree with him on everything, but if he is saying raising rates actually helps the economy, or maybe that was just you, I believe that. And so what we're seeing in the U.S. is that the money supply is actually picking up after only one rate hike. By the way, financial stocks are really, really cheap, and every time the Fed raises rates a quarter, banks make $7 billion more a year because they have $2 trillion in excess reserves. They raise, just do the math, 25 bips times 2 trillion, $7 billion. So if they raise them twice more, that'll be 14 more billion earnings for banks, and they're already at record highs. Yes, sir.
Ryan, along with everyone else, great job today.
Thank you.
One of the slides I didn't have time for was the adjusted monetary base.
Yeah.
Let me just piggyback.
Sure.
Your last comment. Historically, 9 to 18 months after you have a big bump in M2,
Yep.
you're going to be seeing inflation rates.
Yep.
What are your thoughts on that?
I couldn't agree more. That's exactly what Milton Friedman taught us. And so see this aren't the M2 from 95 until today, it's been incredibly steady at roughly 6% growth. I mean, we could debate this for hours and hours, days, but all of a sudden in the last 5-6 months, last week it was up 8.2. The week before that it was up 8.5. The week, and I'm talking on a 3-month basis. So all of a sudden we're seeing this pick up a little. I believe it's because of the rate hikes. Also, people want to get cash out of Europe, right? And so what's interesting about this is that we are seeing the money supply pick up. I do believe inflation is picking up. I think the biggest bubble in the United States today is Treasury bond yields. The good news is munis have sold off, or maybe that's not good news if you held them. But those yields have risen, high yield bonds, investment grade corporate bond yields are higher, senior loan, there's some pretty good deals out there, but I would be really careful about stretching out and buying longer term maturity bonds. By the way, we just wrote a piece. Do you know why the federal government's average maturity for its debt is about 4 years right now? Because if they actually, so right now they pay about 0.7% on their debt. It's some of the lowest ever. If we would issue 50-year bonds at 2.5%, 3%, 100-year bonds at 3.5%, it'd be like you locking in a 30-year mortgage right now, right? We could finance our government spending for 100 years at 3.5% right now, probably. But you know why the government won't do it? Because when they run that through the models of the budget, it raises future spending, and that means they don't have that money to spend. You get that? So if I were to lock in longer term financing, it steals money from me, my ability to spend it on free college today or something like that. So guess what they're doing? They're being bad fiduciaries. They're issuing short-term debt to keep government spending down and putting us at risk of having to have inflation and pay much higher interest rates in the future. A good fiduciary right now would be issuing 30, 50, and 100-year bonds. That's what Apple's doing, that's what corporations are doing, that's what other governments are doing, but ours isn't. Anybody else, real quick? Yes.
Wonderful job, by the way.
Thank you.
And I'm curious, a lot of the problems you're pointing out in government spending, some of that, a lot of it is social services.
Yep.
How would you pay for necessary social services other than what they have been doing?
Right. This is the great question. It's like, I've been pointing out the problems of government spending. We do have social. I'm not an anarchist. I do believe that we need a government, and I'm not opposed to a social safety net. I do believe if we want to do it right, we have to push it down to the local level. I'm a Gunsmoke model guy. I don't know if you remember that. What was the drunk's name in the town? He always had a place to sleep. Every once in a while they'd let him sleep. He wouldn't stop drinking. So what are you going to do? They pay him a quarter to sweep the saloon steps, and he'd go have beer. And then he'd get drunk, and then he'd sleep in the jail, or somebody's barn. And so the local community takes care of its own. But the further you get away, when you start having Washington take care of that guy, now all of a sudden he's entitled, he doesn't owe anyone anything, he doesn't have to do anything, and he never tries to fix his problem. And nobody really wants to help him. And now he becomes a pariah because, we don't need, why should I help you? You're getting help from them. And it actually undermines our society, if I believe. So I think we ought to push it down to the local level, would be my simple answer. Yeah, we'll just go one more, right?
We're...
Healthcare.
Yeah, healthcare. I believe the answer to healthcare, and I don't think we can ever get there. I don't know. America's done some amazing, amazing things. But if you can buy a computer, and now Apple makes it really easy, but so can healthcare companies too, by the way. But if you can go to buy Dell, like if you ever gone to Dell's website, oh my gosh, do I want the 528 gig processor or this one? Is it NVIDIA's the best? I'm reading all these. It is complicated. I did to buy a computer for my kid. He likes to fly flight simulator. And it was like, which one do I get? I have no idea. I'd much rather shop for an MRI. All right, it's way easier. All right, how much does it cost? $400, $500, $1,600. If I go to, the main hospital, it's $1,600. If I go to the local clinic one that's next to the blood draw place, it's $400. So what I'm getting to here is we need a more market-driven healthcare system where the consumer is the one that's paying for things. If you bought food like we buy healthcare, how many of you, you would go into the grocery store and you would pick up steak for your dog because all you do is show them a card. Who would buy dog food for their dog? You just show them a card on your way out. If we had a market-driven healthcare system, prices would fall, we would have more healthcare for more people, and the quality of that healthcare would improve. Northwestern is a public university. I mean, excuse me, a private university, excuse me, I meant private. And we only have 25% private private universities. And that's enough to make the competition so strong that the whole system is the best in the world. And the Northwestern should feel really proud of that because it's these private institutions that are really pushing the competition. All we need, 25%. And that's what we probably need in primary education, and that's what we need in healthcare. And we're going the other way. We're getting less private healthcare and more public. And I think that, as Milton Friedman says, all that does is raise costs and reduce quality. And it does it everywhere government gets involved. All right, thank you very, very much.
Speaking of best in the world, Brian Wesbury.